Meet Jane. Like you, she's in her first year at university studying accounting. Jane struggles with bank reconciliations. Jane needs some guidance from her professor, Mrs. Green. But firstly, Jane needs to know what reconcile means. Reconcile means to make something equal. Bank reconciliation means to note the differences between the transaction records on a company's cash ledger and a bank statement. But what do we actually want to make equal on these accounts? Well, we want to make the company's cash balance equal the bank's cash balance. For each statement, we'll need to keep a record of every cash transaction that occurs within a period of time, such as at the end of every month. Therefore, transactions should be recorded at the same time the cash is put into the bank. However, sometimes both transactions aren't recorded in each account at the same time. Therefore, the bank statement and the company's cash ledger may not be equal for a number of reasons. Adjusting the bank balance. So there are two main reasons the company's transactions from their payments aren't in the bank statement. So firstly, a deposit in transit. So this is when a deposit is made by a customer but doesn't appear on the bank statement. Therefore, the cash has not cleared the bank as of the statement date. Therefore, deposits in transits are added to the bank's cash balance. An outstanding check is a check that has been distributed by the company but has not cleared the bank statement as of that statement date. Also, when adjusting the company's balance, there are two main reasons that the company's transactions from their payments aren't in the bank statement.
So these two reasons are the correction of error and a bounce check.
Any error in recording on the company's cash ledger will be realised once they receive their bank statement. As the bank statement records the correct cash flow, this means the company's cash balance needs to be adjusted.
Furthermore, a bounce check is a check from a customer that has not cleared their own bank account, resulting in the removal of money from the company's bank account, which needs to be recorded on the company's cash balance.
Now, for the company's cash ledger and bank statement to be reconciled, we must adjust these statements so that their final balances are equal.
It is important to note that on the bank statement, the debits are on the right-hand side and the credits are on the left-hand side. However, on the company's cash ledger, debits are on the left-hand side and credits are on the right-hand side.
So Jane, now we are going to do the steps in order to make a bank reconciliation. Step 1. We must find all of the transactions that appear on the cash balance and not on the bank statement. Step 2, we must find all of the transactions that appear on the bank statement but not on the company's cash statement. So now we just found all of the missing transactions on each statement.
But where are we going to record these missing transactions?
This is where the bank reconciliation comes in. There are two sides of a bank reconciliation, the bank side and the book side. All the transactions on the bank statement and not on the books need to be added or subtracted from the cash ledger's final or current balance. This is done on the book side and will form a new final balance. Similarly, all the transactions on the books but not on the bank statement should be adjusted on the bank side, also forming a new final balance. If done correctly, these balances should be equal like shown below.